We're still reviewing the first half of the year with focus now on the Nigerian equities market. Ayodiji Olabisi, investment analyst with Meristem Securities, joins me now. Good morning to you, Ayodiji.
Good morning, Harry.
And thank you so much for joining me on the program today. It's a holiday. The markets are closed. Financial activity is practically at a lull. But was that the same thing that we saw in the first half of the year for the equities market, a lull?
For the equities market, the first half of the year wasn't interesting, I would say, because starting from the month of January, we saw the market going as far as minus 21%, and that actually continued all till May. Before the close of May, where we saw a significant rally in the market, and the market for the first time actually closed in a positive region for about 4%. There were a lot of skepticism, and what caused actually the rally in the market was the FX introduction, which the MPC spoke about during the last MPC meeting. But while the MPC actually gave guidelines, and the guidelines should be released in some couple of time, the specific date was not given. And investors were actually waiting, and when they didn't see that, we saw that the negative sentiment continued also in the equities market. So the positive gains also went to the negative zone until we saw the final guidelines were released. So when we saw the final guidelines as at 20th of May, then we began to see some confidence was beginning to return into the market. We saw the market going as far as 8% positive. That was actually, I think that's the highest the market has actually done so far in half year. And gradually, while that actually came, the rally was caused because investors were expecting a lot of foreign investors to come back into the market, given that the value in the Naira is actually more, it's the depreciation in Naira that makes it actually a lot of counters much more cheaper for foreign investors to actually take position on. And while investors were expecting this bullish rally to happen, we saw a lot of domestic investors came back into the market, and that was where we saw the rally on those counters. So we saw the banking sector going as high as 22%, the index going as high as 22%, even insurance, which is not really being patronized as much, actually benefited about 2% gain also. And that actually continued, but for now, we will say the flexible exchange, the framework, for now, we know that the CBN is still the major participant in terms of the supply segment of it. And while we still expect it to be much more flexible, that is why we've seen there's been a lot of depreciation also in the market also. Investors are beginning to take profit on counters, and which have actually gained significantly in the last period. And that is, as I said, last week, that was on Monday, when the market actually closed. We saw the market going back to positive year-to-date of 1.2%, 2.7%. That's to say investors have actually taken profit on a lot of those counters, because the movement in the FX, probably investors are still expecting a lot of inflows from foreign investors yet. Until that actually happens, you might continue to see the bearish sentiment might continue in the market.
But then, Ayodiji, a lot of, other analysts actually looked at the fact that probably the reason why we saw that topsy-turvy in the market, aside from the Forex, issues that came up, was the fact that earnings that came from the companies listed at the exchange were not quite impressive.
Yeah, the earnings that came from those companies, as I would say, they are not impressive. But there are just very few companies, come to think of it. The earnings season is not out finally. We're not into the earnings season final. Maybe from next week now, we should begin to see a lot of earnings coming in, and then we can begin to just pause and say, okay, the earnings are not too impressive. Yes, for those that have come out, you want to look at them, they are more skilled into the consumer goods sector. You want to talk of maybe the likes of Honeywell and the likes that came from the consumer goods sector. And when you look at all their performance, you find out that their cost to sales ratio actually is the major driver of those negative sentiment. While some of them were able to actually grow revenue within those periods, you find out that their bottom lines were not actually impressive. And the factor that actually caused that, you look at it, it was the cost to sales ratio. Cost to sales ratio, we all know, as earlier spoken, we know the factors which were actually responsible for it, the debt of the FX, the availability to actually import some of those raw materials and which they use for their production. While a lot of them were unable to get the FX, they had to scale towards the parallel market. And while we know what the FX was actually telling at the parallel market, that actually impacted significantly on their cost. And that was able to erode all the positive gains we saw at the top line. That was actually able to erode it. And a lot of them also, given the foreign exposure that they were to the FX, their exposure to foreign FX, that actually have a lot of impact on their expense also. And that was not true good for their bottom line, and that was why we saw the negative returns.
But then for the first half, we also saw kind of positives coming from the management of the Nigerian Stock Exchange in terms of trying to ensure compliance with in terms of early release of their results and the rest of it. So let's quickly just look at how the management actually managed the Nigerian Stock Exchange. What are your thoughts on it?
Well, I think the management has been wonderful so far. They've been wonderful. The exchange, we're beginning to see a lot of changes are beginning to come into the market. Until now, you see some financial releases were brought to the NSE. You just find out numbers. There are no notes to cover to back up those numbers. You have to wait for another 1-2 months before you see those companies actually release those results on probably on their website, and then you can now have more details to what those financials are. But as it stands, the last earnings that was released, that has actually changed. If you're actually bringing your results to the NSE, it has to come with the notes so that analysts can actually know what is actually happening in what segment in which you're just giving us figures to. And you find out that some of these companies, they really don't, for maybe the banking sector and some of the other sectors which are having strong fundamentals and actually have the customer and the investor relation, then you might find out that we have the opportunities to have management visits, but that is not always available for all the companies listed on the exchange. So you might want to deal with a lot of what factors, information which you actually get from their financials, given the authenticity of their auditors also. But for that, we think the NSE have actually done well, and for companies that don't release, the fines are actually coming adequately. And while those fines actually come, you don't want to take the hit of fines at this period where the market is not too impressive. You're not getting a lot in terms of your revenue. You're not getting a lot in terms of earnings. I'm not sure fines are the next things you want to actually bring into it. And while those sanctions also comes, it actually reduces your corporate governance out there. And investors begin to have some negative sentiment towards that stuff. So we think the NSE has been wonderful so far. Even for the insurance companies, that you find out that they rarely release the results as and when you think that has actually changed significantly. We've seen a lot of them releasing as early as every other companies are releasing. So I think the NSE has been wonderful so far.
So still going back to, looking at the sectors and the indices, 5 major ones. We have the oil and gas index, we have the banking index, we have insurance, and we have the consumer goods index, as well as the industrial goods index. Which for you was the most active, aside from the usual suspects? There's the banking index, of course. The others, how do you think that they performed? Do you think the performance was at par? Let's compare it to, first half of 2015.
Compared to first half of 2015, definitely all the index, including the banking index, did not perform as well as the market did the first half of 2015, because they were all hit by the headwinds in which we actually saw in the economy within that period. The banking sector, like you said, leaving it out, I think so far it is still the only index in the positive region, which is about positive 9% so far, NSE banking index, while all other indices are actually in the negative territory. I think for the oil and gas, it is badly hit. It's about 9.7, negative 9.57%. We've seen for the consumer goods about negative 4.5.
The bank is actually at 10.26. I was trying to confirm that.
10.2, okay,
positive 10.26.
Yeah, but you find out that every other person is in the negative region. So you see there for the consumer goods about negative 4.5. You see for the bank, the insurance also about negative 4%. So you find out for the industrial, that is also a negative region, also negative 4. But the industrial is majorly driven by the big short in the industries.
Okay. So, just quickly in like 30 seconds, let's, talk about very briefly your expectations for the first half, for the second half of the year, beg your pardon.
The second half of the year, I think it's going to be far better than what we saw in the first half. The backup you're going to look at that is, do you think the economy will be better in the second half? Yes, I think it's going to be better. So that should also impact positively on the market.
Ayodiji, thank you so much for joining me on the program this morning and sharing your perspectives.